So, Nasdaq futures are currently pointing to a brutal 150-point gap down at the implied open.
Yeah, it's rough out there.
And S&P 500 futures, I mean, they are barely holding the 7,520 support level. The pre-market volume is exceptionally heavy today.
Very heavy.
And look, the overnight session was basically entirely defined by one massive catalyst, which is the U.S. airstrikes on Iranian drone sites.
Right. The tension in the order flow right now is just palpable.
Yeah.
You have an equities market that's fundamentally struggling to hold on to its record highs, and it's caught in this severe risk-off defensive posture.
Defensive is putting it mildly.
Exactly. I mean, institutional capital isn't just pausing, right?
Yeah.
They are actively hedging. They're totally paralyzed.
Well, and just a quick note for you listening before we get deeper into the data. We are maintaining strict neutrality regarding that overnight geopolitical catalyst. We aren't here to take political sides or analyze foreign policy.
No, not at all.
We are just decoding the intense pre-market anxiety inside this highly confidential internal strategy brief from bulls, bears, and the bell. Our mission is to report the economic ripple effects, period.
Right, because for the macro strategy desk modeling this out, that event is purely a variable in a global equation.
Just data.
Just data. And it caused an immediate shock to the energy sector. Brent crude spiked, I think, 2.7% in the overnight session.
Yeah, pushing right toward $95 a barrel.
Exactly, $95, while WTI moved back toward $91. And the internal analysis literally labels this spike a direct tax on growth.
A tax on growth. I mean, that makes intuitive sense at the consumer level, but break down the mechanics for a multi-trillion-dollar equities market.
Sure.
Because a jump in oil isn't just higher gas prices, it fundamentally alters the cost of revenue for almost every sector, right?
Yeah, it hits manufacturing, global shipping, agriculture, even the raw material costs for data center cooling systems.
Oh, wow, even cooling systems.
Yeah. It acts as this instantaneous upward shock to input costs across the board. The cost of doing business globally just went up overnight.
And this geopolitical spark happened at literally the absolute most vulnerable moment.
Yep.
Because at 8:30 a.m. this morning, the market is facing what the desk calls a data supernova.
The triple threat.
Right, the triple threat. Revised Q1 GDP, weekly jobless claims, and of course, core PCE.
Core personal consumption expenditures.
Why?
Which is, the Federal Reserve's preferred inflation gauge.
And pre-market consensus for that is sitting at 0.3% month over month. But look, if a $95 barrel of oil is essentially locking higher input costs into the supply chain, the entity sweating the most right now isn't a tech CEO, it's the Federal Reserve.
Oh, absolutely. Because the entire market rally over the last 2 quarters has been aggressively front-running the soft landing narrative.
Right.
The market just assumed the economy was cooling down enough to kill inflation, allowing the Fed to cut rates.
But not cooling so much that it triggers an earnings recession.
Exactly. It's a very delicate balance. If this PCE print comes in hot, say 0.4% or 0.5%, combined with this fresh oil spike, the mathematical foundation of that soft landing just totally evaporates.
Okay, I see why the institutions are hedging. But wait, if we zoom out for a second, we have all this incredible tech and AI innovation generating literally billions in new enterprise value.
Yeah.
From a pure valuation standpoint, why does a fraction of a percent in an inflation gauge have the power to derail a structural tech revolution?
Well, because it fundamentally changes the present value of future money.
How so?
When you buy shares in a high-growth AI company, you aren't buying their profits today. You're buying a multiple of their projected earnings, like 5 or 10 years from now.
Right, the forward multiples.
And to calculate what those future earnings are worth today, analysts use a discount rate that's based on government bond yields. So if the PCE comes in hot, it validates a hawkish Fed policy, meaning interest rates have to stay elevated. High interest rates act like gravity on those discount models. The higher the risk-free rate, the less those future tech earnings are worth right now.
Which brings us perfectly to the macro dashboard outlined in the brief. And, I mean, the numbers are flashing bright red.
They really are.
The 10-year Treasury yield is testing 16-month highs at 4.52%. And concurrently, the dollar index, the DXY, has hit a 7-week high of 99.36.
Yeah.
The strategy desk notes that the bond market is actively vigilanting the new Fed chair, Kevin Warsh.
Bond vigilantes are basically institutional fixed-income traders who take matters into their own hands when they think a central bank is being too complacent about inflation.
And they're dumping U.S. government bonds in massive volumes right now.
Exactly. And because bond prices and yields move inversely, this aggressive selling drives the interest rate up on the open market. There were daring Fed Chair Warsh to abandon any remaining rhetoric about rate cuts.
They're essentially forcing his hand. By driving the 10-year yield to 4.52%, they're signaling that with baseline inflation seemingly stuck at 3.8%, the Fed might actually need to execute a hike, not just hold rates steady.
Yeah, a hawkish hike. And this creates a severe divergence, what the desk calls the pain trade.
Right, the divergence between institutional positioning and retail psychology. Because retail investors have been deeply conditioned over the last decade of quantitative easing to believe that, every market dip is just a buying opportunity.
Yeah, they assume the Fed will inevitably swoop in with liquidity to save the day.
They are trapped in this Goldilocks mindset, just continually buying the dip on AI momentum stocks.
So retail flow is essentially remaining long and wrong into this data print.
Wait, long and wrong.
Yeah, they are blindly betting on a rescue from the Fed that the bond market's pricing models say is absolutely impossible under current inflation metrics.
Oh, wow.
That is the core of the pain trade.
Yeah.
Retail is playing a liquidity game that just doesn't exist anymore. And this is where the mathematical concept of valuation compression becomes brutal.
Because if you can get a guaranteed risk-free 4.5% or even 5% return just by holding a U.S. Treasury bond, capital naturally flows out of risky equities.
Exactly. And if the 10-year yield breaks that critical 5.00% threshold, it stops being just a valuation problem for Silicon Valley. It transforms into a solvency crisis for everyday consumers.
Yeah, credit card APRs, 30-year fixed mortgages, auto loan refinancing, they all become prohibitively expensive.
Which crushes consumer discretionary spending.
Right, which then feeds back into lower corporate earnings. The narrative shifts instantly from higher for longer to higher forever.
Higher forever.
Yeah, and on top of that yield pressure, you have the DXY at 99.36. I mean, a historically strong dollar has to be a massive headwind for the Magnificent Seven and large-cap tech companies doing business internationally.
Oh, it acts as an invisible tax on their global operations.
How does that actually work?
Well, if a U.S.-based cloud provider is selling software in Europe or hardware in Japan, those foreign buyers are paying in euros or yen. Because the dollar is so strong right now, those foreign currencies are relatively much weaker. So when that tech giant repatriates that international revenue and converts it back to U.S. dollars for their quarterly earnings report, the exchange rate simply erases a massive chunk of the capital.
It just compresses their global revenue margins mathematically, regardless of how good their actual product is.
Exactly.
So if a 5% risk-free yield makes buying software multiples mathematically unjustifiable and a strong dollar is eroding international margins, capital has to flow somewhere else.
And it is.
Yeah, looking at the internal numbers here, it is flowing heavily into the physical foundation of the TIS boom. The brief labels this the AI power trade.
The market is executing an aggressive sector rotation out of pure digital assets and into heavy utilities and grid infrastructure.
And the strategy desk points out a staggering metric here. Hyperscaler capital expenditure. So the combined infrastructure spending of the largest cloud and AI providers is projected to hit $700 billion this year alone.
$700 billion.
Yeah.
It's massive.
The narrative has completely shifted. The critical bottleneck for scaling artificial intelligence isn't semiconductor fabrication anymore, it's the juice.
Yeah, it is raw electricity. Investors are suddenly realizing that these massive data centers require 247 uninterruptible, clean baseload power.
Right, you cannot run a gigawatt-scale AI training cluster on intermittent energy.
No, if the wind stops blowing or the sun goes down, you can't just pause the data center. A microsecond brownout corrupts the training parameters. These hyperscalers require baseload power that runs continuously at maximum output.
And to address this specific bottleneck, the pre-market brief highlights the White House actually invoking the Defense Production Act, the DPA, to fast-track the manufacturing of grid transformers and domestic nuclear capacity. And again, just to reiterate our strict political neutrality here, we are not analyzing the politics of the DPA. We are solely examining the market's violent repricing of utility assets in response to this injection of federal urgency.
And it is violent. Boring, historically slow-moving utility stocks are suddenly exhibiting the volatility and growth premiums of early-stage tech companies.
Right, look at VistraCore, ticker VST. That's a prime example.
Oh, absolutely. The pre-market volume on VST is massive. It's pushing the stock up, I think, 22% before the bell.
Yeah, 22%. And the catalyst is a heavily rumored behind-the-meter nuclear power agreement with a major cloud provider.
Let's define the mechanics of a behind-the-meter deal really quick.
Sure.
That means the hyperscaler is building their data center directly adjacent to the nuclear power plant. They're plugging directly into the reactor's output, completely bypassing the public electrical grid to guarantee exclusive, uninterrupted supply.
Wow. It's like the classic gold rush, right? We aren't just selling pickaxes to the miners anymore. We've suddenly realized we have to build dedicated, multi-billion-dollar power plants right next to the gold mines just to keep the lights on.
That's a great way to put it. And if Vistra clears its $310 resistance level on the open, the order book suggests a massive momentum squeeze.
Because short sellers who bet against a utility company trading at these crazy multiples will be forced to cover, driving the price even higher.
Exactly. But this drastic pivot toward physical power generation is creating a severe bifurcation within the broader tech sector itself.
The rising tide of AI is no longer lifting all boats.
Definitely not. AI hardware and infrastructure companies, the ones physically laying the concrete and copper, they have a massive buffer because of that guaranteed $700 billion in hyperscaler spending.
But software as a service, SaaS, and digital ad tech companies don't have that physical necessity driving immediate, inelastic revenue.
They are bleeding out. The market is aggressively repricing them. The valuation gap between the companies building the physical power infrastructure and the companies just building software applications on top of it is literally turning into a canyon.
And you can see that exact tension playing out with Amazon today, ticker AMZN. The brief highlights mounting activist investor pressure ahead of their shareholder meeting. The core conflict is energy transparency. Institutional investors are caught weighing the explosive growth of AWS against the soaring costs of maintaining carbon-neutral compliance.
It is a tug of war between raw compute growth at any cost and strict environmental mandates.
Right.
If AWS can demonstrate that they are holding their profit margins steady despite these massive new energy outlays, the desk sees Amazon pushing toward the $270 level.
But if today's 8:30 a.m. PCE inflation data comes in hot, Amazon's heavy capital expenditure suddenly looks like a massive liability.
Yeah, potentially dragging the stock down through support levels toward $235.
Which brings us to the actual pre-market volume right now, because the rotation is brutal and it's creating massive disparities on the board. Let's look at the specific pre-market gappers.
Okay.
Snowflake, ticker SNOW, is up a massive 35% on a monster Q1 beat and the announcement of a $6 billion AWS deal.
And that specific deal is temporarily silencing the skeptics who argued that cloud migration growth was stalling out. It provides guaranteed revenue visibility.
Then you have Unusual Machines, ticker UMAC, ripping 33% higher in the pre-market.
Yeah, the internal tracking notes that drone-related defense stocks are catching aggressive bids on reports of fast-track domestic defense funding.
Heavily influenced by the overnight geopolitical news, of course.
Of course.
But the real tell on market sentiment is Marvell Technology, ticker MRVL. They delivered a modest earnings beat, yet the stock is gapping down 3%.
Because Marvell's price action reveals the underlying fragility of the entire semiconductor space right now.
Right. The market is no longer satisfied with just a good quarter.
No, good isn't good enough. Institutional capital is demanding absolute, flawless perfection and explosive forward guidance revisions.
If a semiconductor company isn't raising their future revenue estimates by double digits, the market treats it as a failure and aggressive selling pressure kicks in. But looking at the entire pre-market screener, the absolute standout is Eli Lilly, ticker LLY.
Oh, yeah.
The strategy desk is flagging massive relative volume following a leaked Phase 3 clinical abstract for a new diabesity longevity combination drug.
This is wild.
The institutional narrative is actively shifting its focus from simple weight loss therapeutics to actual health span extension. Let's unpack the mechanics here. How does an institutional trading desk even begin to build a financial model for human longevity?
I mean, it requires a staggering paradigm shift in macroeconomic modeling.
Bet.
The GLP-1 weight loss drugs were merely phase 1, right? Phase 2 involves clinical data proving that these specific compounds actively delay broader age-related decline.
Like reducing cardiovascular events, slowing cognitive degradation, preserving muscle mass.
Exactly. Wall Street isn't just pricing in the profit margins of a new pharmaceutical product anymore. They're literally attempting to price in the second-order economic effects of the average functional human lifespan increasing by 5 to 10 years.
The ripple effects of that are immense. If a massive demographic lives an extra decade, that is 10 more years of discretionary consumer spending, 10 more years of housing and energy consumption.
But simultaneously, it creates an unprecedented strain on fixed income retirements and pension funds that were never modeled for that kind of longevity.
Right.
Which is exactly why the desk suggests Eli Lilly is on the verge of completely decoupling from the traditional healthcare sector.
It stops trading like a pharmaceutical stock subject to pipeline risks.
And starts trading like a foundational demographic utility.
Wow.
Yeah, if this trial data holds up to peer review, their bull case targets $1,200 a share.
But the risk model explicitly warns that if the broader market decides this longevity play is already priced to perfection, any slight weakness or delay in FDA approval could trigger a sharp technical drop back to the $1,050 support zone. The economic implications of millions living an extra decade while we are simultaneously fighting over grid power and sticky inflation are just staggering. But bringing it back to the immediate reality of the trading session, the brief outlines a very specific, dangerous setup at the opening bell today. They are explicitly warning institutional clients about a liquidity trap.
Navigating the first hour of trading today is going to be incredibly treacherous. The desk has defined their absolute lines in the sand.
Okay, let's hear them.
For the S&P 500, the critical support level to watch is 7,520.
Right.
And for the Nasdaq 100, the line is 29,850.
And the focal point of this danger zone is what they are calling the 30K trap on the Nasdaq.
Yeah.
The internal order book shows a massive seller wall stacked heavily just above the 30,000 psychological mark. Let's break down the anatomy of a trap like this. How does this actually function mechanically on the tape?
So it is a structural trap driven by what quantitative desks call market maker buy model exhaustion.
Okay.
Here's the mechanism. Retail investors wake up. They see the hype surrounding the SpaceX IPO ticker, SPCX. They read the headlines about Snowflake's AWS deal, and they start aggressively FOMO buying at the market open.
Okay, so this tidal wave of retail market orders pushes the Nasdaq index price rapidly upward toward that 30,000 level.
Right. But the institutions, the smart money, they see that volume and they know the algorithmic limits.
They know that the automated market maker models, which provide liquidity to the market, are basically programmed to stop buying and step back once the price deviates too far from the fundamental mean.
Which happens to be right at 30,000.
Right.
Precisely. The institutions aren't buying that breakout. They are exploiting it.
Wow.
They are using that artificial retail-driven price spike as a massive liquidity pool to quietly execute their hedges. They have limit sell orders stacked at 30,050.
So they are dumping their long positions into the retail buying frenzy and simultaneously using the elevated options premiums to buy downside puts.
Exactly. The brief is unambiguous in its directive to clients. Do not chase the 8:30 a.m. momentum spike. It is a fake out designed to trap late retail capital.
So the institutional playbook for today is just defensive patience. Let the 10.0 a.m. volatility settle, wait for the algorithmic rebalancing to finish, and just watch the bond market.
Yeah, the strategy desk's bottom line is that if the 10-year yield crosses 4.60% in response to hot inflation data, those Nasdaq support levels will mechanically snap.
The bull cases evaporate, margin calls trigger, and the bear takes the bell.
It is a stark reminder of market hierarchy. It simply does not matter how revolutionary the AI enterprise earnings are, or how transformative the behind-the-meter nuclear power deals or health-span longevity drugs might be.
Right.
If the foundational macroeconomic cost of borrowing money gets too high, the entire house of cards faces intense structural pressure. Macro forces will always eventually overwhelm micro narratives.
Always. Today's market is a violent tug of war. On one side of the tape, you have incredible, almost science fiction level technological acceleration. I mean, the physical build out of a new AI infrastructure, the revitalization of nuclear power via the DPA, and pharmaceutical breakthroughs fundamentally altering human lifespans.
Yeah.
But on the other side, you have brutal macroeconomic gravity, sticky core inflation, geopolitical conflict actively disrupting global energy inputs, and soaring bond yields vigilanting the Federal Reserve.
And look, even if you aren't an active day trader staring at a level 2 order book, these behind-the-scenes institutional currents directly dictate your reality.
Absolutely.
The tension outlined in this pre-market brief controls the APR on your credit cards, the actual purchasing power of your 401k, and the physical construction of the utility grid that powers your home.
The outcome of this battle between the bond market vigilantes and the Federal Reserve will establish the baseline economic reality we all have to navigate for the next decade.
Without a doubt.
We open this deep dive by comparing today's market to a high-speed AI train, realizing the tracks ahead are warped by an economic earthquake. But the data reveals a much more complex collision.
Yeah, it does.
If artificial intelligence is true, physical bottleneck is the raw generation of electricity, and new pharmaceuticals are successfully extending the consumer lifespan of the average citizen by a decade. What happens to global resource competition in a world where the central bank is forced to keep the cost of capital higher forever?
That's the real question.
It's a structural paradox to keep in mind the next time you see a notification about the market testing new highs. Thanks for joining us on this deep dive.